Tonight we're going to talk about one of my favorite indicators, moving average convergence and divergence. Or for short, MACD. Now, MACD was developed in the 70s by Gerald Appel. Now, if you think back, if you're old enough, I am, but if you're old enough to remember the 70s and you were around when we were trading, first of all, we didn't have any internet. We didn't have any computers. And predominantly everything was traded in the stock market. We had some commodities trading. We had some other small assets that were trading. Forex wasn't developed yet. CFDs didn't exist. Cryptocurrency surely didn't exist. So most everything was developed for the stock market. Now there's a lot of indicators and oscillators out there that people have said they're great, but their greatness came from the stock market. A lot of them don't work in the Forex market or the cryptocurrency market or the precious metals market, or they don't adapt to our new online trading. There's a lot of indicators out there that just aren't fast enough. Their calculations aren't short enough that it helps us in our type of trading, because we're trading in short-term markets and we need very flexible and very responsive indicators. So MACD helps us spot changes, or originally to spot changes in strength, direction, and momentum, and the duration of a trend of a stock's price. Now, as the online trading, let's forget the history of the markets, but let's talk about as the online trading market developed, Forex trading, CFDs trading started to develop, we found ways that MACD could be adapted to this market. And MACD has become one of the most prominent and most successful, most used Forex indicators because it is so responsive to help identifying the end of current trends and the momentum in a trend, as well as the strength of that current trend. It's a very easy oscillator to use and understand. Now, MACD is typically placed under our charts. We have certain indicators that are placed over top of the charts and over top of the pricing on the chart, and others that are dropped on the bottom of the chart. Most of the indicators are actually placed on the bottom of the chart. Excuse me. So MACDs, we're going to go over a live chart in a minute, but you have to understand what makes up these lines on this indicator. So the concept behind MACD is fairly straightforward. Essentially, it calculates the difference. Don't have to memorize this, but you have to learn it. And we'll go over it on a live chart in a minute. But it calculates the difference between an instrument's 26-period and 12-period EMA, exponential moving average. Of the two moving averages that make up the MACD, the 12-period EMA is obviously the faster one, while the 26-day is slower. In the calculation of values, both moving averages use the closing price of whatever period is measured. Then we use a 9-period EMA of the calculation of the difference between the 12 and 26-day, which gives us what's called the MACD, the trigger line. Okay, so that's a lot of words to put in your head without any visual concept to understand. So let me pop up a live chart here. Okay, so on the bottom of my chart down here, I've placed the MACD. Actually, that's okay. So the MACD that was on the bottom of the chart, I've just enlarged so you see it visually. So the MACD consists of several lines. And I'm going to turn off some of them and we're going to start from the beginning. Okay, so this line that would be on the bottom of our chart is called the MACD line. this line came from a 12-period moving average let me put a 12-period moving average. So I'm sorry, let me get these set up for you properly so you get it right. So we have on our charts the 12-period moving average and the 26-period moving average. That's the two blue lines up above. That the moving average is right on the price chart. The difference of these, which is the difference between you take the 12 period and subtract from it the 26 period, and that number gives us what's called the MACD line, which is charted down below in the blue. So this line down below is the difference between these two moving averages above. It's based on a center line of 0. So if that was 0, the difference between this line and this line would be plotted here, and this is a 1. The difference between this line and this line. Now, when we see the two lines cross over, what is the exact number when you subtract it from the two numbers is 0. So that would be right here where it crossed the 0 line. Here where the 26 period, you got larger than the 12 period, and you took the 12 and subtracted the 26, you would always get a negative number. So whatever that number is, it's just plotted down below. 12 period minus the 26 period, subtract it, plot it down below. So at that point forward, we no longer need these moving averages above. So I've removed them from the chart, and we just have this blue line, which is known as the MACD line. And let's go once expanded, so it's the whole screen here. So that MACD line doesn't tell us much of anything, but it's a starting point. So again, here's the 0 line. Everything above is a plus. So that means when we see it above, we know the 12-period moving average was larger than the 26 period. When we see it below 0, we know the 26 period was larger than the 12 period, because that's when it became negative. If you take a number and subtract something that's larger than that, it's a negative. When both lines are equal to the same value, they would be 0. Now, this doesn't really tell us all that much about price. So we need a second line put on our chart. And this line is called the trigger line. Because otherwise, if we were just using this line above, we'd basically be using a moving average crossover strategy. Okay? So whenever the two moving averages crossed over, depending on which one was larger, you'd either buy or sell. Well, that's a very simplistic, basic strategy for the markets. But we need an indicator that's a little bit more advanced than that. So we then create the trigger line. Or sometimes known as the signal line. Let's make these a little bit thicker so they're easier for you to see. So the blue line, and you could use whatever color you want. The color of the lines is unimportant as long as you know which one's which. The blue line is our MACD line. The gold line is what's called the trigger line. Now, the rule of thumb when trading MACD is that when the trigger line crosses the MACD line, If it crosses and goes below, it's a sell signal. If it crosses and goes above, it's a buy signal. So in other words, whenever the blue line crosses the gold line, it's alerting you to something. And we use the word signal or buy or sell. It's really just an alert. It's hitting you on the back of the head and saying, hey, look at me. Here's a potential. Do some analysis. So these are the three basic lines that make up MACD. And they're three relatively simple calculations. The other things that we can see in this MACD line is the depth of the movement, how strong the trend is. Now, this takes a little bit more understanding of the MACD. Okay, we can also see overbought and oversold situations, and we can see the speed or the momentum of the move. You say to me, how do you see all that in these little lines? Well, it has to be the price in the markets were relatively slow, but the depth of these peaks and valleys, say, help tell us something. But in order to make it easier for us to see visually, MACD has created what's called a histogram. This histogram gives us a much better visual representation of what is happening in the markets. Now, this histogram down below here is nothing but a visual representation of the values of these two lines that we've drawn on the chart. Now, I don't use these lines for anything. I simply use my histogram because I could see everything and anything I need to see within that histogram a lot easier with less things on my screen. Now, every time the histogram changes color, it's because the MACD is either moved from red to green or green to red because it's equal to each other or hit the zero line. When we see the MACD, the histogram downward, we know that at that point, the 26 period was larger than the 12 period. We also know that the MACD line and the MACD trigger line crossed each other when it hit zero. We can judge the depth and the speed and the momentum of the movement by looking at the valley or the format that we see in the movement of price. See here, we can see that this movement had a lot of momentum. We can see how long those histograms were. We can see how deep that market is, but we can see it's also been retreating as we came around. So this histogram tells us a great deal about what's happening in the markets and helps us understand whether price is overbought or oversold. It helps us understand whether there's a potential buy or sell alert that's going on that's saying, look at me, here's the potential. We can see if the trend is ending or beginning. So we can see a lot of things in this histogram. So let's go back to my PowerPoint. Let's talk about what we would look for in this histogram now that we have this indicator on the bottom of our charts. So the MACD is perhaps the best all-round study available. Indeed, I and others consider the MACD to be one of the best single oscillators available, and it's valuable to learn the nuances in and out. Other than the price trend itself, MACD is one of the most accurate probability signals. The new trader would be wise to concentrate on really learning the MACD and its histogram before moving on to other oscillators. So we can notice that the MACD helped traders notice that the trend changed at a very early stage. Before we saw a shift in the actual price, we could see that this trend was losing its momentum and shifting. So this is a key part of the indicator. and something we will delve into deeper. But using MACD as a trigger into trades. But before we can do that, you probably noticed the zero line. And on the MACD indicator, this is the key part of the indicator, as it shows us when there's been the shift in the EMAs, which is a shift in the overall market scenarios. So MACD will cross the zero line as the faster moving average intersects the slower moving average. In other words, the 12 and the 26. For those of you who don't understand what we talk about faster and slower, anything based on a moving average, the shorter the period of the moving average comparison is always going to be the faster. The longer period of a moving average is always going to be the slower. The reason being is, in this case, we're using a 12 and a 26. The 12 period moving average, if you say using a 1 hour chart, a 12 period moving average looks back over the last 12 1 hours on that 12-hour chart, the 1 hour chart. Whereas the 26 period looks back over 26 hours. The 12 period will react faster only because it's taking the most current 12 segments and dividing it by 12. Where the other one, the longer one, is using 26 segments and dividing it by 26. So in other words, if gold was trading at 1400, 1400, 1400, 1400, 1400, and then it jumped to 1450, and you added all those together and divided it by 12, okay, gold might have, the moving average might have jumped to 1402 or 1403. But if gold had been 1400, 1400 for 25 periods and then just jumped to 1450, and you divide all that by 26, it might only be showing you the moving average of 1401 because the shorter period is more responsive. So it's called the faster because it reacts faster to changes in the market. And this holds true whether you're looking at MACD or whatever you're using. So MACD can be helpful for noticing potential trend changes as the very early stages of the currency pair. However, if we wait for the zero line crossover, we are essentially trading a moving average crossover strategy. As I mentioned, if we're just looking for this crossover, that's all we're seeing is when the 12 and the 26 period crossed each other over. By applying the MACD trigger line, we've now changed the whole scenario and the whole concept because we're no longer looking at the zero line for the MACD line, but we're looking at the zero line and the crossovers from the MACD line and the MACD trigger line. So this is where the signal line or the trigger line comes into play. The signal line is simply a moving average built on the value of the MACD line. So by default, this is commonly set at 9 periods. Building on a relationship with the MACD line itself, traders will often look for an entry opportunity when the MACD line crosses the signal line. When the MACD line crosses above or over the signal line, it is looked at as a buy signal or buy alert or a transaction signal. It is not telling you to buy or sell now. It's telling you, hey, look at me for a buy or sell potential. So to more closely follow the relationship between the MACD and the signal line, traders can follow the histogram, which is simply a bar chart plotted around the zero line to indicate the relationship between the MACD line and the signal line. Now, MACD tells us 3 different stories. It shows us convergence and divergence. It gives us crossovers which show overbought and oversold conditions, and it gives us the transaction signals. I use MACD. I don't trade divergences at all. I don't even look. I never even notice them. Okay. The MACD line First of all, as I said, gives us buy and sell alerts. Now, when they talk about the divergence in MACD is when the MACD line is moving in one direction while price is moving in the opposite direction. So in other words, here we see the MACD line is easing down while price is moving up. This is divergence. Okay. Like I said, I don't ever see it. Okay. Or if somebody points it to me on a chart, it says, look, there's divergence. But I'm not, my eye doesn't see easily the difference between the price movement and the way the indicator's moving. And another thing is because I solely use the histogram, I also never see it. But it doesn't matter. Even if you see the divergence, you still have to wait for something to happen to tell you to do something. And if there's a breakout or a shift in the markets, you're still going to see it. But keep in mind, the MACD is a derivative of a derivative. So the MACD histogram is an indicator of an indicator. What it does, it takes an indicator and puts it together in an easy to interpret format. So this means that the MACD histogram is 4 steps removed from the price of the underlying security. In other words, it's the fourth derivative of price. The first derivative, we start with the 12-period moving average and the 26-period moving average. Remember, we put the 2 lines on the price chart. Then we take the 12-period and subtract it from take the 26 period and subtract it from the 12 period. That's our second derivative. Our third derivative is we build the MACD signal line, which is just a 9-period moving average of the MACD line. And then the fourth derivative is the MACD histogram, which is the MACD less the MACD signal line. So the base of this indicator is the securities price. It takes 4 steps to get the actual price of the MACD histogram. So what it's doing is taking a moving average crossover strategy and massaged it. It's made it, gives us more data and made it more successful. So while not necessarily a bad thing, chartists should keep in mind that when analyzing the MACD histogram, it is an indicator of an indicator. Therefore, it is designed to anticipate the signals in MACD, which in turn is designed to identify changes in price momentum of the underlying security. So as with MACD, the MACD histogram is also designed to do the same thing, to give us convergence, divergence, and crossovers. The MACD histogram, however, is measuring the distance between the MACD and the signal line. The histogram is positive or above 0 when the MACD line is above its signal line. Positive values increases the MACD divergence from its signal line to the upside. So it builds those mountain ranges, those peaks and valleys. And those peaks and valleys on that histogram can tell you a lot about the price movement, the trend, and the momentum in that current movement and the speed. So it has become standard to plot a separate moving average alongside the MACD, which is used to create a signal of shifting momentum, which is a signal line. A signal line also is the trigger line and is created by taking the 9-period moving average of the MACD line. And this is plotted alongside the indicator. So those are the 2 lines on the bottom of the chart, or it is the value of those bars on the histogram. Now, the basic interpretation or the transaction signals we get from MACD is the basic bullish signal or the buy occurs when the MACD line crosses above the signal line. And it generates a buy signal. When it crosses the other way, it generates a sell signal. And we also want to watch the center line. As mentioned earlier, the MACD indicator is calculated by taking the difference between a short-term moving average and a long-term moving average. Given this construction, the value of the MACD indicator must be equal to 0 each time these 2 moving averages cross. And to me, that is the most important piece of information you get, MACD, is when it shifts from red to green or whatever colors you use for your histogram, or when the MACD line crosses the signal line. Those are, at that point, an indicator that's, again, smacking you on the back of the head, in my case, saying, Barry, look, Barry, start doing something. Okay. That to me is more important than anything else out there. Okay. Now, there are some drawbacks to MACD, which you have to know, because MACD doesn't give you entry points. It doesn't give you entry prices. It doesn't give you exit prices. And the biggest drawback is a lot of times you get false signals generated by MACD. The biggest disadvantage of using this indicator to generate transaction signals is that a trader can get whipsawed in and out of position several times before being able to capture a strong change. See, MACD, when you get the crossover and it issues a transaction signal, it tells you that, to buy or sell. It doesn't tell you that it's going to move far enough in that direction for you to cover the spread and what price to get in the market and what price to get out of the market. So you can't use it to calculate risk reward ratios, and you can't use it because it's not going to tell you how far that momentum's going to, how far the price is going to move. So it can give you a buy signal. If you were to buy, you'd end up losing money because you couldn't get in and out of your trade fast enough. But when you go back and look on the charts, you see it was completely correct. But because MACD doesn't calculate anything to do with the actual price movement, you have to be very, very careful. So what it's doing is giving you alerts, giving you a heads up. It doesn't really help you to set your stop loss. It doesn't really help you set your target points, and it doesn't really tell you entry points. What it tells you is alerts. It's an indicator. It's indicating that there's a shift in the market or a potential in the market. Now, traders should be aware the whipsaw effect can be severe in both trending and range-bound markets. Another MACD is its inability to make comparisons between other securities. Sometimes, even though we have some general rules here, you have to take a look at how MACD behaves in these particular areas or these asset classes. Okay? Because as we know, cryptocurrency has big shifts in the market. It's steadily moving and it moves big dollar amounts or big amounts. Okay? So we might have to understand different relationships with MACD and cryptocurrency. We might want to have different understandings or explanations or uses of MACD when we're using small moving stocks as opposed to high volume stocks. Okay, so you need to fix this problem. And you do that by simply watching how MACD reacts to the class of stocks, to the class of assets you're trading, and make some adjustments in your interpretation. But the MACD indicator is one of the most popular tools in technical analysis because it gives traders the ability to quickly and easily identify the short-term trend direction. The clear transaction signals helps to minimize the subjectivity involved in trading, and the crosses of the signal line make it easy for traders to ensure they are trading in the direction of the momentum. Very few indicators in technical analysis have proved to be more reliable than the MACD. And this relatively simple indicator can quickly be incorporated into any short-term trading strategy. So momentum in charting is like momentum in physics. If you throw a ball in the air, it will ascend at a slower and slower pace the higher it projects. After monitoring the changing momentum, a person can determine when the ball will stop climbing and change direction and descent. And this is what the MACD indicator lets you see. You can see that shifting, changing momentum and be prepared for when it shifts back in the other direction. So just like in physics, momentum changes occur before the price of an asset changes. So I hope you learned a little bit about MACD, how to apply it in your trading, how to understand its lines and how to read it, and how to improve your overall market interpretations. Thank you very much for joining us tonight, and we'll talk to you again real soon. Good night.